watching Stock Watch. I'm Zinati Kuma, and joining me to unpack your stock-related questions today are Grant Nader from Benguela Global Fund Managers and Sanelisiwe Tofile from All Weather Capital. Be sure to send your questions through via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X @BusinessDayTV using the hashtag Stockwatch. Thank you so much for your gentlemen. Thank you so much for your time. Let me get my English right. I think the confusion is also coming from the fact that we can't see Grant.
It's confusing me as well, guys.
It is black. But don't worry to our viewers, he is there. We just can't see him at the moment. Hopefully we'll get him at some point. But even if we don't, it's fine. I think a picture will be coming up, Grant. But we are not really here for the picture. We are here for what you have to say. Sanelisiwe, let's actually start off with you. Let's talk about monetary policy because the Fed came out with a hold on interest rates. I don't know if that was a surprise or not. Let's actually talk about that because a lot of people had actually been expecting the Fed to cut.
Yeah, I think, somewhere between expectation and hope for a cut with regards to the Fed. I think the main thing is that obviously they are watching the U.S. economy, particularly inflation and jobs. And, inflation is still trending lower, but it's not kind of getting inside the range. So that's one of the things. And, on the other side, the economy still remains robust. Employment is still at quite low levels. So it gives them room to remain high on interest rates. So I think they are being quite a bit data dependent in the way they are approaching this particular problem. But I think it's probably right to think that they will maybe have another cut or two somewhere in the future. But again, inflation is proving to be quite slow in getting back into their comfortable range. I think you will see rates probably moving down slower than what we might have expected before.
Well, what is also interesting is the Rand's reaction, because I would have thought that because the Fed decided to hold and the South African Reserve Bank cut, I would have thought that maybe would have given the Fed quite a bit of a knock. But in fact, I feel like it's strengthened a little bit below 18 Rand 50 against the US dollar. Grant, what's your take on the Rand's reaction, I guess the market reaction on the differences between what the Fed did and what the SARB did?
Yeah, I think it's a combination of things. First of all, I certainly think this rate cut was expected. There were a few question marks a week or two ago, but coming into today, it was in the price. So I wasn't expecting any negative reaction that wasn't already priced in. I think part of the Rand strength is the dollar softening a little bit, and that's been a pattern over the last week or two. Commodity price is very strong. That's another move that's very good for the Rand, the current, commodity currency that we are. And just a general, an improving sentiment towards emerging markets seems to be taking hold as the dollar starts to lose its stranglehold on the rest of the world. And I think that I think it's just that combination plus the self-help positive macro story that we have. There's a general positive sentiment around the Rand that I've noticed for some time now.
And actually, you're right, because the miners are up significantly today. Anglo-American Platinum up almost 6%, Kumba Iron Ore with a gain of more than 5%. Sibanye Stillwater's also there contributing. Sanelisiwe, it's always fascinating looking at the moves in those commodities, because I think just yesterday or sometime during the week, we had Amplats down 5-6% as well, together with the other resources. I don't know, it's because I can imagine that this commodity sector, like a lot of people don't sleep at night looking at what they're doing. They're so volatile. How does one even navigate this space? Do you even try?
Obviously, volatility does provide you with opportunities. That's kind of my view about it. But, as Grant has alluded to, a lot of what happens to commodities also is dependent on the dollar, because obviously, things are priced in dollars. So, any kind of weakness in the dollar will kind of support the underlying commodity prices. And we'll see that, platinum and palladium spot prices so up in the 2 to 3% ranges today. So that's kind of where the PGMs at least are following the price. And I think you see also some of the other commodities going up. The only one a little bit confusing is that's also up, maybe just up with the recent market, I suppose, even though the oil price isn't necessarily that strong. But I think a lot of those moves do kind of feed into the dollar weakness, and obviously the underlying markets in which they go to also play into the underlying demand for these underlying commodities. And I think that's what the share prices are following.
Well, let's take a look at a commodity counter that came out with numbers. Glencore, Grant, seeming that a strong second half led to them meeting their production guidance there. What stood out for you? I guess also just looking at the fact that the company deciding to keep its coal assets was a good thing.
Yeah, I mean, look, it was a solid second half production update, but year on year they're still down, 2% in total. So I would say they didn't have an amazing year from a production point of view, but not too bad. They are still, they're glad they've held on to coal, but it's not really an asset that's, the coal price has been lackluster, to say the least. Yeah. Copper down 66% for the year, copper production, and that's been one of the few bright spots in terms of commodities. So I think it's a fine update. I think they're still a business that's well positioned. I like their copper portfolio. I like their marketing arm that makes money out of movement in commodity prices and trading them. So it's a solid update, not amazing, but I think they'll have the ability to ramp. If we see commodity prices sustain this recovery, I think you'll see them push through that production number and come through stronger on that side. So it's okay, solid.
Just on Glencore, Sanelisiwe, because of course about a week or 2 weeks ago we heard that they may be in discussions for a merger with Rio Tinto. Just looking at Glencore as a standalone company, would this be one that is offering some sort of bullish opportunity just as a standalone? And how far do investors look at Glencore in terms of a potential deal here?
Look, I think the benefit in Glencore is in the copper asset. I think if you look at what BHP were trying to do with Anglo American a few months ago, I think they were also trying to probably get a hold of the copper assets within Anglo American. We've spoken, I think, in previous sessions around the benefits of copper and the green energy and where the demands for copper are coming from. So I think if you're looking at counters like Glencore and American and whichever other companies, you really are trying to get a hold or get in front of this demand for copper, which is still, I think, on a longer term basis, still the trend we're going towards. There's short term kind of ebbs and flows, and you see the prices fluctuate, but I think on a longer term basis, there's Grant.
Am I online?
Yes.
Finally, I figured out the setting while I was lecked out. I was busy fiddling.
Yeah.
So the long-term prospects for copper are still good. So any M&A activity, I think, will come from people trying to get a hold of any copper assets they can find. And I think that's what makes the likes of the Glencore attractive to whomever might want to purchase it.
I'm also just talking about M&A activity. You look at gold. There is a gold a question here. And we've been seeing a lot of M&A activity when it comes to copper, metals and minerals of the future. Grant, what about gold? I think the last kind of M&A activity thing that we saw was, what was it? Goldfields with Yamana. I can imagine now these companies also have gotten a windfall because of the gold prices. And obviously we know that miners tend to look for acquisition opportunities when they have a lot of money. Is there any word on the street about any kind of potential M&A activity boom in the gold mining sector?
Well, it's an interesting one. You're right about this. Is normally, given this kind of raging bull market we've seen in gold, you would expect a little more activity. there aren't a lot of great assets out there. We did see that JV between Goldfields and Anglos that was talked about, and they are developing. The Goldfields is developing some new mines, but I think the challenge has been the cost control. So the gold miners haven't benefited anywhere near as much as you would have hoped from this strong gold price. Costs have risen dramatically. I mean, the all-in sustaining cost of a lot of these miners is $1,600, $1,700 now, which would have been loss-making only a couple of years back. So I think they are still grappling with all of this latent inflationary effects, and I think that wave of M&A is still to come. There's probably a bit of a lack of sort of incredulity about this gold price. It's like the least talked about bull market out there. I've never seen a gold bull market that's got so little coverage. Gold's at all-time highs. It continues to trade incredibly well, and yet very few retail investors are really involved, and you're not seeing that kind of hype you would ordinarily see around this kind of thing. So it's a little bit strange to me, and it actually suggests there might still be some legs in what's going on here.
Well, quite interesting, because I mean, this is the second viewer this week that is talking about shorting gold. What do you think about shorting gold at these levels, given the massive run in 24? Sanelisiwe, why is it now, there's this big discussion about shorting gold? Is it just investors thinking that this bull market just does not have a long runway to go at this point?
Look, I suppose it's human nature, when you see sort of bottom left, top right type of chart, and you think maybe this gold price has done too much. But then you also have to ask yourself what has been the cause of this rally in gold. And I think really the past few years, I mean, my mind immediately goes back to, say, for instance, the Ukraine invasion from Russia. You've had quite heightened geopolitics. You've had tensions now recently in the Middle East. You've had recession fears out of Europe and various other political issues out of Germany and France. You've had a various kind of list of things. You've had I guess prior to the pandemic, you also had low rates, which also good for gold. So you had a number of factors factoring into the elevated gold price. And I think for where the gold price is now, people are still potentially looking at, do we solve the Middle East? Does the Trump administration help, solve the Russia-Ukraine, which might then cause investors to be more comfortable to buy risk assets, which might be a muted environment for gold. I think that's perhaps where the question is coming from. But, in my mind, there are still a few, I guess you can call them tail risks, which make gold still a safe haven that some investors would hide in, which might support the share price, rather the commodity price going forward. Yeah. So it really is a safe haven asset that people like to hold in times of uncertainty.
Right. Sanelisiwe was actually saying that it's always about tech stocks, but knowing from Stockwatch, it's always about Sasol. So I guess that's a good break. At least you get to talk about something else. All right. Let's get to ASML and TSMC. The viewers asking about those counters on a long-term buy. Just chips in general, chip companies in general, starting off with you, Sanelisiwe, what is your take considering what is happening in that landscape right now?
Look, I think despite the events of this kind of past couple of days this week, the long-term prospects for, tech and AI are probably still relatively positive. In the past couple of days, because of DeepSeek and whatever else has come out of China, you had the view that, there might be less demand for these high-tech chips. There might be less, spending for the companies at the forefront of AI if they can produce their models at cheaper, in a cheaper way. So that could have possibly put a bit of a cloud on the likes of TSMC and ASML. But I think as, I guess these models proliferate the market and more people kind of are able to make cheaper models, I think there'll be still a need for more computational power going forward. So I think the prospects for these companies are probably still positive. And I mean, it's been a bit of an arms race right now to get the best model out at any cost, basically. But I think what DeepSeek has done is kind of shown that you can be more efficient about it, but it doesn't mean that people are now going to start buying less chips and using less semiconductors. So I think that the market is still positive.
And I mean, we did have ASML coming out with numbers that were quite strong recently. And then we also have Taiwan Semiconductor. Grant, on your side, I know that ASML is also seen as, I guess, the more defensive one because they make the machines. Just talk to me about that, and also just putting in TSMC there.
Yeah, absolutely. I think ASML is in a very strong position. They have a quasi-monopoly, well, an actual monopoly on the highest end chip production machinery, the lithography. I think that if you believe the world is going to continue to move forward in AI, no matter which shape or form, whether it's China, whether it's the US or anywhere else, the ASML is going to benefit from that long-term demand. So they're well placed, taking a 3, 4, 5-year view. I think it's a great investment. Even a shorter term view there, even if there's some volatility. TSMC, they are a greater and greater share of their revenues coming from high-end chip production. They've sold all their capacity, and they're also benefiting from the challenges that Intel and Samsung has. So a lot of the production that may have gone to competitors is going to TSMC. I think they're in a very strong position. But yes, bear in mind it is a more cyclical business. So that means there are ebbs and flows and ups and downs in terms of the complete demand cycle. But I still think TSMC, for what you get for the price, offers one of the more attractive entries into the AI game if you're going to play in that space. So, we still like it, and I think it still offers relative value in the space.
Well, there's a viewer who's tired of playing in the American stock market space. He says one sentence succinctly, my English, succinctly sums up the American stock market. America is overowned, overvalued, and overhyped to a mind-boggling level. Comment, Sanelisiwe.
So, I mean, the US market has been driven to a large degree by the Mag 7 or tech generally. So if you are someone who still likes tech, I mean, I think you might want to look towards China and the East. I mean, because again, just going back to DeepSeek, what DeepSeek has probably likely shown is that Chinese companies are also quite as capable, as the US companies in kind of playing in the AI space. And if you look at the valuations there, they're not anywhere near as high as what US tech is. But if you're trying to maybe, as an option, go look outside of tech, I mean, the tech or the AI adopters and tech adopters who are going to actually benefit from using tech are probably the next leg of growth now. Companies that might might benefit from the use of AI. So that means looking at companies that do all sorts of things, manufacturers, retailers, banks, insurers, whoever. And all those kind of companies are probably trading at much more attractive valuations than say, for example, tech. So I think there are definitely options for investors to look at outside of the US and outside of tech.
Well, let's talk about those options. Which markets and stocks can a contrarian, sane and sensible investor look to invest in? PS none in the USA, please, Grant.
Okay, outside of the US, Europe is cheap. It's had a bit of a rally, but it's still cheap. Outside of the big global players, the luxury space, the healthcare space, they've got their standard bearers and they're great businesses, LVMH, Novo Nordisk, etc. But they've got a good banking franchise there, and you'll see that if their economy picks up and the yield curve steepens with these rate cuts, that's favorable for the banking sector, so that'll be an opportunity. I think high-tech industrial automation is playing out globally. There's demand in China, there's demand in the US, there's demand everywhere for that kind of thing. So some of the Swiss companies, those high-end industrial technology, heavy technology, including Japan, they've got a lot of that. I think Mitsubishi has some of those. So there are opportunities. Look around. Most markets on a relative basis are cheaper than the US. And don't be fooled because a market's gone up over the last year, because last year all markets went up. They went up significantly, but on a relative basis, they're all still most are still cheap relative to the US. But also within the US, the small and mid-cap space is significantly cheaper than the tech sector. So, you do need to, and not all stocks are made equal, and not all PE valuation multiples are made equal. There are opportunities in all geographies, actually.
What about the geography of South Africa? SA Inc.
Yeah,
suddenly
there
see
too.
Yeah, your thoughts?
Yeah, look, I mean, I think what's happened since our elections in May last year is that the, the pessimism within South Africa, and I think from investors outside of South Africa has turned and improved. But what we haven't seen is that foreign investors especially have not actually pulled the trigger and come into the market. So I think once hopefully foreigners get comfortable and other investors also get comfortable that the investment case for South Africa is improving, I think you start seeing that SA will start to rally. I mean, we did have a short rally post-elections given the outcomes, but I think a lot of that has now either a combination of being pulled back or being priced in. But now I think we need more interest and more actual kind of money coming in to kind of help the valuations go back up. But I definitely think that the prospects for South Africa have improved.
Yeah, I was actually looking at H&M's results today. Not too pleasing there. It got me thinking about our retailers here in South Africa. And I was actually looking, Truworths was down about 2%. Not too bad today. Just looking at the numbers that we've gotten from our retailers, but also the fact that our inflation is at the lower end of that target range, but also getting the 25 basis point interest rate cut today. Do things look better for our retailers here on the JSE, Grant?
The rate cut's definitely better for them. The consumer's in reasonable shape, but there's also quite a lot of competition from the foreign online players, the Sheins and of the world and Temu. I think they're okay, but I think the challenge they've got is they had a decent year last year and their valuation multiples expanded ahead of what's expected to be, good earnings coming through. Then obviously if the earnings don't come through, then that's where your risk lies, and then the multiple needs to reset. So I think they've come back some way. I think if they pull back a little bit more, you can nibble there. And although discretionary retail is always going to be a challenge unless we start hitting some of that growth expectation. If we print 2% GDP, which I think is possible, I think that surprise is on the table, then they actually still look attractive to me.
Yeah, all right. Well, let's get to your stock picks for today, Sanelisiwe. What are you finding attractive?
So mine's very simple. I think Raynet is quite attractive. It's a holding company. They used to hold various assets, but now they've since sold a few of them. They've sold now recently their BTI holding. So now what's left there is a financial company called Pension Corp. It's about 70% or 50% rather of the NAV. They've got about 20% of the NAV in sort of private equity type investments, and then they've got 30% in cash post the BTI sale. So that cash gives them optionality. They've paid down all the debt. It gives them optionality to do other investment activities or perhaps return capital to shareholders. And it's now trading at a 50% discount to NAV if you extract the cash. So I think it's a quite attractive investment opportunity at this stage.
All right. Grant, where are you placing your bets today?
Much to the dismay of the previous viewer, I'm looking at the US. I like Meta. I've liked it a long time, and I've picked it a couple of times on the show. I continue to see evidence that they are one of the few companies to be monetizing the AI opportunity, the generative AI intelligence that's giving them. They are front and center, and the whole, all the companies with a large platform, they've got 3.35 billion users. They're giving return on investment to the advertisers. You're seeing it in user engagement. You're seeing it in the increase in the ARPU, so the revenue per user. And this company is growing margins beautifully. I think they're still relatively cheap. You're trading around mid-20s on a one-year forward earnings basis, cheaper than a lot of other stocks, with a significant free cash flow, high-quality business with a good growth runway still to come. So even though it's done well, I think they're operating so well and they're growing very strongly that it still offers relative value and it's attractive, in my opinion.
All right. Well, thank you so much for your time and for your insights and analysis today, gents. That is all for tonight's Stock Watch. Thanks to our guest, Grant Nader from Benguela Global Fund Managers and Sanelisiwe Tofile from All Weather Capital. Up next, The Close. Stay watching.